All right, welcome to today's Explainer. We're going to dive right in and take a hard, analytical look at something that touches pretty much every single one of us, the modern banking and credit system. You know, in our financial world, credit is this massive double-edged sword. When you use it strategically, it's an incredible tool. It can absolutely build immense generational wealth. But when it's misunderstood or slightly mismanaged, it can instantly trigger this paralyzing cycle that just drains your resources. So today, we're dissecting the actual anatomy of the bank debt trap. We're going to look at the pure mechanics of how it operates, the warning signs to watch out for, and most importantly, exactly how to dismantle it.
I want you to ask yourself honestly right now. Are your loans acting as tools that you actively control to build your net worth, or do they feel a bit more like quicksand? If you're feeling financial anxiety right now, let me just say you are absolutely not alone. And it's not necessarily because you did something horribly wrong. The modern banking ecosystem is literally designed to minimize the friction of borrowing while maximizing their returns through incredibly complex interest structures. Basically, it's very, very easy to slip up.
So, here's our game plan for today's Explainer. First, we'll cover the core mechanics. Second, the loan minefield. Third, the warning signs and the true toll. And finally, breaking the cycle.
Okay, let's jump right into part one, the core mechanics. Let's really look at the underlying biology of this trap.
You know, financial insolvency rarely happens overnight. It's much more of a gradual descent. Mathematically speaking, you are in a debt trap when you make your regular payments, but your principal amount just isn't going down. In fact, it might even be creeping up. Why does this happen? Well, it's driven by compound interest, where you are literally paying interest on top of previously accumulated interest, and heavily skewed amortization schedules. In the early years of a long-term loan, your monthly payments are heavily weighted toward paying off the bank's interest rather than reducing your actual principal. It makes your debt feel absolutely frozen in time, like you're just running on a treadmill.
And this whole situation is usually driven by severe debt-to-income or DTI imbalance. Financial experts generally agree that your total loan payments really shouldn't exceed 30 to 40% of your net income. That's your safe zone. But when your fixed loan obligations cross that red 50% threshold, you've entered the trap zone. At this point, you simply lack the liquid cash for your daily living expenses. What that means is you're inevitably forced onto high-interest credit cards just to buy groceries and, well, survive.
Moving right along to part two, the loan minefield. Because let's be real, not all debts are created equal.
We urgently need to look at the different strains of this financial virus, starting with the absolute most common gateway into a debt trap, credit cards. These things can hit high-end annualized interest rates of 42%. No way, right? But yes. The massive deception here lies in the minimum amount due. Banks usually require a minimum payment of just about 5% of your outstanding balance. Now, paying that 5% protects your credit score, sure, but it rolls over the remaining 95% at exorbitant rates, often 36 to 42%. If you only pay the minimum, it can literally take over a decade to clear a small balance, and you're going to pay vastly more in interest than the item originally cost. Oh, and remember, once you carry a balance, the grace period on any new purchases, poof, it vanishes. Every new coffee or grocery run starts accruing daily interest immediately. That means a simple $5 latte might effectively end up costing you $20 over time.
Now, if you thought 42% was bad, take a look at the predatory APR of payday and instant loan apps. These apps brilliantly mask their true costs. They might offer you instant cash with zero paperwork and just a seemingly harmless 2% flat fee for a 15-day loan. Sounds great, right? But mathematically, if you annualize that, it translates to an annual percentage rate of almost 50%. Because the loan term is so short, borrowers who can't pay are forced into this brutal rollover cycle. They end up paying heavy extension fees or literally downloading a second app to pay the first. It's pure financial quicksand.
Let's contrast some of these everyday loans. We hear real estate called good debt all the time, right? But even mortgages can completely squeeze you. If you max out your eligibility to buy the absolute most expensive house possible, your mortgage might consume up to 60% of your income. That makes you house poor with zero buffer for emergencies. Or even worse, if the housing market crashes, you could face negative equity, meaning you owe more than the house is actually worth. On the flip side of that, auto loans are inherently bad debt. To make pricey cars seem affordable on a monthly basis, banks offer these extended 7 to 8 year tenures. But cars lose 20 to 30% of their value the exact second you drive them off the lot. For most of that 7-year loan, you are what we call upside down, owing the bank vastly more than that rapidly depreciating asset is actually worth.
We also have to throw a caution flag on personal and student loans. Personal loans frequently fund consumption, weddings, vacations, things that don't generate any future income, so your net worth drops while your liabilities rise. And definitely be wary of the consolidation illusion. This is when you take a personal loan to clear your credit cards. It often leads to people feeling debt-free, only to subconsciously max out those credit cards again, leaving them stuck with both debts. As for student loans, the hidden danger is interest capitalization. Even during that payment moratorium while you're studying, the interest is silently ticking up. When you graduate, that interest gets added to your principal. You enter the workforce paying interest on top of interest, which is absolutely brutal if you're facing an income mismatch in a stagnant job market.
All right, part 3, warning signs and toll. Let's talk about recognizing the trap. With the mechanics and the minefield out of the way, let's just slow down for a second and empathetically discuss the real human symptoms of this condition. I want to guide you through some very clear red flags, and I highly encourage you to do a quick, zero-shame self-audit of your daily habits against this list. Are you violating that 50% rule we talked about? Are you forced to use credit cards for basic necessities like your electricity bill? Are you borrowing from family or taking out new loans just to hit your payment deadlines? If you have absolutely zero savings capacity, if you're facing credit rejections, or if you're dealing with constant sleeplessness and anxiety about money, you are exhibiting the undeniable symptoms of a debt trap.
The absolutely crucial point here is that this goes way, way beyond just numbers on a bank statement. There is a very heavy psychological weight. Chronic debt causes severe anxiety, depression, and it's a leading cause of marital breakdown. As the research notes, borrowers often experience something called cognitive tunneling. This is where your focus narrows entirely to just surviving the next payment date. When you're trapped, your brain's focus is locked into survival mode. This state of constant panic actually prevents you from making rational, long-term career or financial decisions. It literally changes how you think.
And if we zoom out to the macro level, the big picture, this impacts all of us. When the majority of the middle class is trapped paying off high-interest debt, household disposable income just vanishes. This causes a massive drop in consumer spending, which hurts retail, manufacturing, services, the whole shebang. Ultimately, heavily indebted households pose a systemic risk that can slow down national GDP growth and even trigger actual economic recessions.
Okay, let's switch gears and bring some energy back. Part 4, breaking the cycle. Let's look at strategic, actionable escape routes. Because here's the good news. This is a mathematically solvable problem, and here is your definitive 5-step escape route. It starts with step 1, a ruthless financial audit. You have to list every single principal, interest rate, and payment you owe, and implement a bare-bones budget. You got to cut all discretionary spending, dining out, the streaming subscriptions, and redirect every single spare piece of currency toward debt repayment. You just have to face the numbers head-on.
Step 2 is choosing your framework. You basically have 2 proven options here. The avalanche method is mathematically optimal. You pay the minimums on everything, but you funnel all your extra cash into the loan with the absolute highest interest rate. This absolutely saves you the most money over time. But if you're someone who needs a rapid psychological victory, use the snowball method. Here, you attack the loan with the smallest total balance first, regardless of the interest rate. Clearing that small debt quickly gives you the massive motivational boost you need to tackle the bigger mountains. So choose the one that fits your psychology.
Steps 3 and 4 are all about smart consolidation and liquidation. If you have maxed out credit cards hitting you at 36%, approach a bank for a single personal loan at, say, 15% to pay them off. This mathematically stops the bleeding, but, and this is crucial, you must lock or close those credit cards immediately so you don't run them up again. For step 4, you have to emotionally detach from your assets. If you have a fixed deposit earning you 6% but a personal loan costing you 18%, holding that investment is literally costing you money every day. Liquidate the low-yielding asset to clear the high-interest debt. It just makes mathematical sense.
Finally, step 5 empowers you to take control when things look bleak. If a default is imminent, do not just skip a payment and hide. Proactively approach your bank. Believe it or not, banks actually prefer to restructure your loan by lowering the rates or extending the tenure, rather than fighting costly legal battles to recover their money. You can also seek out registered nonprofit credit counseling agencies who can professionally negotiate realistic settlement terms on your behalf. You have leverage, but only if you communicate early.
Look, escaping a debt trap takes time, it takes discipline, and it requires a fundamental shift away from debt-fueled consumption. So I want to leave you with this final, provocative thought to really challenge your daily consumer habits. Are your loans working to build your wealth, or are you just working to build the bank's? Take a hard look at your statements this week, put the frameworks we discussed today into action, and take back control of your financial future. Thanks for joining me on this explainer. Keep learning and stay focused.